what we ignore is the fact, and it is a fact, that markets have different characteristics for sure. So we definitely miss opportunities to specialize for a given market, right? So we are underfitting, as you would say. But I've in my career, I've never seen anyone go bankrupt because they underfit. But I've seen loads of people go bankrupt because they overfit. So, in terms of the risk reward, I'll bet on underfitting all day long and stay away from overfitting as much as possible.
Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager due diligence or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we will have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager, Niels Kaastrup Larsen.
Welcome to another episode in the Open Interest series on Top Traders Unplugged, hosted by Moritz Gebhardt. In life, as well as in trading, maintaining a spirit of curiosity and open-mindedness is key, and this is precisely what the Open Interest series is all about. Join Moritz as he engages in candid conversations with seasoned professionals from around the globe to uncover their insights, successes, and failures, offering you a unique perspective on the investment landscape. So with no further ado, please enjoy the conversation.
Hello everyone, it's Moritz here with episode number 13 of the Open Interest series on Top Traders Unplugged. Today, I'll be speaking with Bill Gebhardt from 10 Dynamics, a London-based systematic trading firm. Bill has a really interesting background, which can be divided into two parts. In the earlier stages of his career, and after having completed a PhD in finance at Cornell University, Bill was an assistant professor of finance at the University of California at Davis, focusing on applied trading strategies grounded in behavioral finance theories. He then left academia to work for Barclays Global Investors, being responsible for the research and development of trading signals for their long-short equity portfolio. But in the second part of his career, Bill moved over to the trading side, overseeing prop trading businesses at Deutsche Bank as the managing director and head of European power and gas trading, and also at Trailstone, a prop commodities trading business, where he was in charge of the European book. And then in 2020, Bill and a small team of colleagues started 10 Dynamics in London. Now, let me also tell you why I decided to invite Bill onto the Open Interest series here, and that's because first, the way they trade is different to most other CTAs in that they run an almost continuous trading process on several different timescales, day and night. And second, because of Bill's background in the energies arena and his deep experience with spread and arbitrage trades in the power and gas markets. Okay, let me stop it here. Bill, welcome to Open Interest.
Thanks for it. So it's a great intro. You do it much quicker than I do. I appreciate that. You hit the highlights. It's good.
There you go. I always like that. Well, speaking about your background, and as I've just mentioned, Bill, you started as an academic, as an assistant professor. So you were teaching under the assumption that markets are efficient or very close to efficient, and that the trading systems which you and I run really shouldn't work in practice, but they do.
Yep.
And so you ended up in this space, and I ended up in this space. But how do you reconcile this? You've crossed the border, so to say.
Well, for sure, and I think it's really one of the most amazing. I don't know. It is all of what we're doing is this giant anomaly. And it's been a few years. I haven't read any of the academic literature recently, but certainly when I did my PhD and everything I'm aware of has been like, well, at the very least, the market should be efficient enough that price-based strategies shouldn't work, which is, it's the most basic form of market efficiency. And yet you have, countless hedge funds that seem to be doing it successfully and doing it differently. Right. You talk to lots of people like ourselves. And I think you see the breadth and strategies and different time frames, different So there's some incredible knowledge gap that we have in our understanding of how markets actually function. I think about this all the time. I feel like I've run out of great ideas to solve the problem. I do feel like what we're doing is purely empirical. We're doing something that works without any real grounding in why it works. And I really feel like if somebody could figure out why this works, they could come up with a pretty good strategy potentially that's better than everybody else. But it's amazing to me that and if you look at what the market efficiency type people typically do when they have something they don't understand, they say, oh, it's a risk factor, right? It's some undefined risk factor that investors are exposed to, and so therefore it has a return. But it's pretty hard to argue what the risk factor is in trend, or CTA type strategies that all seem to be producing money over time and correlated. But where's the risk? Particularly when if you look at the return profile, it tends to do well in high volatility periods, which is when the true market risk factor that everybody focuses on, beta, does poorly. So it's actually a hedge to the traditional risk factors, which again goes counter to, if anything, the risk premium on trend following should be negative, not positive. And yet it's positive and consistent. It's really an odd puzzle. I don't know. I don't know what the answer is.
Look, I recently listened to an interesting conversation with Cliff Asness say that maybe one of the reasons or a source for the edge is the fact that these systems cause pain, and it's a feature, not a bug. It's kind of like by design, and because there is pain involved in the way that we trade with drawdowns and inconvenience, and you're buying highs and you're selling lows, you're kind of like doing the opposite of what our human brains want us to do. That's the edge that just doesn't go away.
Yeah, definitely. I mean, that's what I've always thought, is that it's some psychological thing, right? That's why it's repeatable, is because humans aren't changing that much. So we do the same things, we have the same tendencies, and so therefore it's exploiting some sort of psychological trait. But the problem is, the market efficiency idea is that if it works, it should be arbitraged away, right? That people should be out competing each other to try to make their strategy quicker or whatever, and so the return, sort of like a true arbitrage, that if enough people do it, it should go away. And the ironic thing is, we're all doing the systematic trading where we believe that we've figured out something that's predictable, and we don't want to tell anyone else what we're doing. And why do we think we don't want to tell anyone else what we're doing? Because we're afraid it'll be arbitraged away if everyone does it, right? So somehow we all are believing that market efficiency is true. That's why we all are hiding what we're doing. But at the same time, what we're doing sort of proves that market efficiency isn't true. So I know one of those two things is not compatible. I'm not sure which one it is, but I think that's this kind of crazy. People are so secretive about what they're doing, and what they're doing is magic. I don't know if if you go on Wikipedia and you look up technical analysis, it's listed as a pseudoscience. So we're all pseudoscientists out here doing technical or systematic trading, however you want to brand it, which is kind of funny.
It is. Now, Bill, back to your firm, 10 Dynamics. 10 Dynamics. Why is it called 10 Dynamics? I'm sure there's a reason behind it. Spill the beans. Tell us why.
Our at least the process or the history that I've been through is a bit different, I think, than more of a quantitative approach to how a lot of people end up doing systematic trading. Really, because my trading background was on the proprietary side and the more fundamental based, bottom up kind of typical commodity trading strategy. I had built these tools over time to help me with my timing, particularly. And they were all tools based on, I have a very kind of, I guess, philosophical view on how the markets actually move and work. And I built tools specifically to capture that idea. And over the years, I increased the tool set, and I eventually got to 10 different column signals, which have kind of stood the test of time now. And I haven't really changed. I think the last signal that I changed was probably in about 2013 or something like that. So they've been around for a while, but there's 10 of them. And so 10 dynamics came from the 10 signals that we use. It seemed to be a trend to put a number in front of your name. So we thought, well, 10 dynamics makes sense. It's trending.
Yeah, sounds good to me. You just mentioned you have a view or a philosophy about how markets work. What is that philosophy?
Well, this goes back to, I think I've told this story a few times, but I think, it goes back to my PhD in I sat in a class with a professor who's quite a famous market efficiency guy, built one of the asset pricing models that I think a lot of people work with. And before he did the classic, well, here's a round, he doesn't say anything. Here's a chart. What stock is this? Was that kind of a class? And everybody made their guess. And he says, "Oh, surprise, surprise! It's a random walk. It's not Apple or anything like that." And and then I went from that class and thought, well, that's kind of interesting. But I went on my own and generated about 100 different charts of random walks. And I had trading experience before I did my PhD. And when I looked at those charts, I thought, well, these don't look anything like what actual charts look like. And so I just felt like, well, statistically, maybe that description of prices makes a lot of sense and those kind of Brownian motion type things. But I thought there was a lot more structure than what comes out of those kind of models. And I got exposed to, I think a lot of people in our industry look at sort of Mandelbrot and the misbehavior markets and the fractals kind of ideas. And I really do think there's something there. I haven't been able to really pin it down specifically, like the mathematical side of it, but it definitely influences us philosophically in terms of how we build the models and how we weight things and combine our strategies. And as you mentioned earlier in the introduction, how we look across multiple timeframes. That all comes from this, fractally idea that really prices should be predictable on lots of different timeframes, and there should be some self-similarity there and things like that. And that and it's been the guiding light, I guess. If they're talk about what is it that markets are actually doing, that one thing seems to work pretty well for us. And I think there are other people out there doing it, but I think it's an important perspective to have when you're looking at price behavior anyway.
Now, speaking about the systems or tying that back to the philosophy, are the signals, the 10 signals that your firm runs, are they all rooted and grounded in trend? Is trend following the only thing you do, or do you also trade other signals?
I would say that of these signals, 8 out of 10 are trend, or trying to identify trends. Where 2 out of the 10 are more reversal in nature. But because we equal weight all of our signals, what that effectively means is the reversal signals tend to act like profit-taking signals. We would never find ourselves counter-trend, like truly against a trend on any time frame. We certainly do end up lightening up our position under certain situations. We have these separate signals, and we talk about them a little bit, publicly. Our reversal, we call it the reversal probability, which is just those two reversal signals by themselves. And you can have moments where a market's trending strongly and the reversal probability is very low. And then you can have times where actually the market's trending strongly and the reversal probability is really high, right? So that feeds into our overall positioning as we scale based on the different indicators and how they, or the different signals and how they offset each other.
Got it. Now, one of the many interesting things that you do is that you run an almost continuous trading process. At least this is my understanding when I had a look at the materials that you shared with me and the pre-call that we had. You are using intraday data. You're pulling it in all the time. You are then resampling it, I think every 30 minutes, if I remember that correctly. And then you trade on multiple different time frames, from 30 minutes or like very short term to like 2-week look backs, all of that. Now, this comes with a lot of operational complexity because you need to have the engine and the machines running 24/7 or 24/5. How do you, just give us some background on that. How do you handle all this? This sounds like a big tech lift.
It is a big tech lift. And probably we went in a bit naive, or certainly I did, because I hadn't really implemented something, as you say, that's complex. It's the whole self-driving car issue, right? It's, if everything's going fine, it's great. As soon as a rabbit runs across the road, what happens? It's the same with what we're doing. And to be honest, we just got Well, I think a couple lucky things happened. We built this system in the era of Python and object-oriented coding, right? Which immediately lent itself to a concept where we created this validation idea on all of our objects, and so every object is continually being tested if it's valid or not. And then you basically have to walk through all your process and say, for every step in the process, there's an input and an output. How can the inputs be wrong and how can the outputs be wrong? And there's lots of different dimensions that you're looking at, like how frequently do things change? How much do they change? Is there missing values? All that sort of stuff, right? But that's for every different type of object. And then all your objects interact with each other, right? So you have this chaining that happens between everything. So you're constantly evaluating the validity of each of the objects inside your system and all the instances of those objects, and then catching, when one of those objects is behaving abnormally in some way. And then you kind of pass it to, well, it's a semi-automated system where it goes into another system that tries to decide if it can figure out what's wrong. And if it can, then it can fix it. And if it doesn't, then you have, it gets elevated to the humans to deal with. So we have a lot of different messaging and that sort of stuff set up so that we're constantly in contact with the machine, if you will. It's telling us what's going on and if there's anything abnormal. And I think we got kind of lucky, really. If I look at, we certainly didn't go into it with that design idea in mind, but what's happened is it's really a robust way to do it. And I honestly, I don't know how other people do it, so I don't know if it's unique or not, but it really provides a huge amount of control and confidence to be able to do that. And if you don't do that, I think it's so easy to have, if you're going to trade on an automated basis, as you say, across, throughout the day and a relatively frequent interval, then the potential for problems is there, right? And you have to be quite careful about dealing with it. And it was a little, at the beginning, it was as we were figuring it out, it took quite a lot of testing to, and as you do, you try to break the system in every way you can think of. But even things like, we have a database, everybody has a database. What happens if, you make a query to the database and the data you get back is corrupted or unexpected in some way, or maybe for some reason you get something old in there, and all those. Well, we're now up to like hundreds of checks that we run across all the, hundreds of different instances of our objects, and so it's quite robust in the way it handles that. But it's one thing. I kind of probably tell I'm a bit proud of it. If I had to rank the system versus the control of the system, which one I'm more proud of? Actually, I don't know. It's a toss up. I think they're both super important when you're trading in an automated fashion.
Look, I don't think it necessarily makes 10 Dynamics unique. I guess your setup is unique because nobody else has built it in an identical way. But most of the CTAs out there, or most of the funds in our space, they would trade a daily bar. They wouldn't necessarily dissect the day into 30-minute intervals, right? Or use tick data. So one of the complexities that comes with that is, garbage in, garbage out. Do you have a continuous process of checking the validity of the data, the cleanliness of the data? How does that work?
Yeah, that's all part of the ongoing checks that are happening. So we have, like, for instance, we have a raw data object, which is the data that comes directly from the exchange that has its own validation and cleaning process that it goes through. And you have different checks around volatility and gaps and, all that sort of stuff to make sure that things are coming in correctly. And, you're right. I think running everything on a 30-minute basis is versus a daily kind of process is a order of magnitude more complex. But I don't know, I've never been involved in high frequency trading. I can only imagine that that's even another magnitude of order more complex in how you have to manage things. Because while we do run 30 minutes, we're still batching. We're not streaming, right? So I think if you're in a streaming data setup and you're doing all low latency stuff, I think then, yeah, you better have some pretty robust systems to do it. So I wouldn't even want to have to tackle that. I'm glad that we're really as low as, I think 30 minutes, honestly, is kind of the limit for what we do. We look at the profitability per trade by time frame, it's a monotonic increasing function, right? So the shortest time frames are the least profitable, and the longest time frames are the most profitable. So that, I think you reach a limit where capturing breakouts or capture whatever you want to call a trend, capturing movements in a particular direction gets hard once you get, when your frequency gets too low. Then it becomes all about microstructure and bid-ask stuff and all that kind of stuff that we're not really interested in or involved in. But
So that's interesting. You just mentioned that you're not streaming, but you're batching, or you're batching 30-minute blocks, right? Does that mean that the quickest your machine needs to run is kind of like a 30-minute time frame, because you would get one 30-minute batch in and say, you now have a 30-minute open, high, low close, and maybe your signals goes, okay, buy or sell on the next 30-minute close. So you would, in that example, you would have 30 minutes for the machine to run the next set, come up with the new signals, and then, put it into your execution framework, which I presume is the way you trade, probably fixed based and automatic. So you don't have humans pointing and clicking into the order book. You just every 30 minutes run the machine.
that's absolutely, yeah. We run it every 30 minutes. We do it. I mean, like a lot of people do now, we do a huge amount of parallel processing. So we kind of like run each asset as an independent thing. So we run all the assets at the same time every 30 minutes, and we can process everything in about 5 minutes. And that's the entire, signal space plus all of the adjustments, all the positions and everything. So we're pretty quick, I think, in how we digest the data. So really it's like you run every 30 minutes, you run for 5 minutes, execute orders, check to see what comes back. There is, as you said, if you're gonna do this, you do need to be doing, some sort of auto execution. We use algos, but you do have to monitor if things are not getting filled or whatever, depending on liquidity. So that you are doing stuff in the intervening 30 minutes with your orders, and if you're using limits and stuff and adjusting them based on market conditions. So you do the process around the execution, I would say, is more of a continuous process, but the actual system itself is, a 30-minute batch.
When we look at the data, certainly in equity markets, but also in other markets, throughout the day, what we see is that there is liquidity clustering at the open and at the close, or at settlement in the case of a futures contract. But there's also volatility clustering, right? I mean, most of the noise happens at the open and at the close. This is kind of like where the action is. And you have a reduction of volatility on average between these 2 points. Now, with your system, because you're not necessarily targeting the settlement or the open, you'd be trading at midday. Do you see a performance improvement? Do things really change when you kind of like create your own bar that is no longer tied to the exchange settlement, but you're now saying, okay, I'm settling at 10:30 in the morning, 1.5 hours after the market has opened? Do you see, performance differences there?
Well, it's actually an ongoing research area for us, because as you said, the close to open gap. So if you're going to trade daily and then you wait for the close to get your signal and then you trade on the open, which everybody does, I think there are definite strategies to improve on that. I think that is an easy way to give away some money on everybody trading at the open when the signals are coming in on the close from the prior day. So we're testing things, and there's some interesting results like, daily bar is close to close, but you could do a daily bar from, as you said, midday to midday. It's a daily bar. And do we really think that running midday to midday is going to be a worse performance than close to close over time? I don't know, but it might be better when you consider the close to open gap, right? So we are looking at things like definitely, it looks like potentially delaying execution also can work better, even though you do get a reduction in volume or in liquidity. Now, the one thing I will say, we're small enough now. We don't have any liquidity issues anywhere in anything we trade. We're not really worried about liquidity. It's a future problem we hope to have someday. But for now, at our current size, it's not really, the liquidity is fine because we trade such a diversified basket too. That's what helps.
You also mentioned that on average per day, you have zero 0.7 to zero 0.8 trades per instrument. So it's kind of like you're touching every instrument almost once every day, doing something with it. And then you have an average hold period of 2 weeks. So I guess it's fair to put you more in the short-term traders bucket. Would you say that that's fair? I mean, it doesn't sound like a long-term trend following strategy.
It's a little bit, there's some nuance to it. So because what we're doing, the way the model works, and because we're trading so many timeframes at once, we're effectively scaling in and out of our positions all the time. So you're right. So we're making adjustments to our positions of about 5 to maybe 10% each day. So something like, as you said, 70% of our assets will trade each day. The adjustment of the max position will be 5 to 10%. So we're kind of continually scaling in and out of things. And when we say our turnover is 2 weeks, that is specifically that change from say we're 10% long an asset, and then we move to 15% long, and then back to 10%, right? That is a 2-week holding period. But if you look at our net position, so on a given asset, net long or net short, how long are we net long or net short? That's more like 2.5 months. So when people ask about our holding period, it's like, well, if you're talking about our net position, that's more like on the monthly, month to 1 to 2 months, right? Which is long term. But our trading is actually shorter term. So our turnover looks more like a 2-week type turnover.
The other thing that kind of like jumped at me when I looked at some of the documents you shared with me is you're saying there's 0 parameter optimization going on and no overfitting. And I was kind of like, well, yeah, that's nice, but it's also very difficult or maybe even impossible, because as soon as you start working with historical data, I mean, you're working with that data set. It's, what's your view on this? I mean, how do you not over-optimize anything? How do you avoid overfitting? Also, maybe speak in that same context about the risk of underfitting, which I think is also a challenge, not fitting enough. Just share your thoughts on this, please.
Yeah, I think this is one of those areas where we're maybe a bit different. And you're right. I mean, our signals have been developed over time in real prop trading situations, right? So for sure, they've been influenced by the success or weaknesses of those signals over time. But they're not the signals. The way the signals work is it's not. They're not like moving averages that have a time frame, or breakouts that are looking at the last X number of bars. Those types of parameters aren't in any of the signals that we use, because our signals are self-referential, if that makes any sense. So basically, we take the noise out of the prices. We kind of we take a price series and we turn it into these linear segments of up and down moves. And then all of our signals look at the last 3 segments. So if you're in an up move right now on a time frame, then you have the prior down move, whatever that was, and you have the up move that preceded it. And so all of our signals are looking at those 3 segments and determining if, just on a true false basis, are they changing in some way, right? So, if we're looking at, a simple thing is, well, how long have we been going up? If we've been going up longer than we went down, then, we'd consider that bullish, let's say. So there's no parameter there, right? There's no, the only parameter comes in the process of creating the linear segments. And that's really just a volatility-based thing that we do. I guess you'd say, well, you're picking some sort of number for that. We're just using sort of basic statistics. We're not doing anything fancy there, but we haven't optimized, what's the exact volatility parameter we should use in every market to create these charts. We use the same one in everything, and it just comes from statistics, right? There's no backfitting in that sense. So when we say we don't optimize parameters, we don't really have parameters to optimize. You're right, though. Like what we ignore is the fact, and it is a fact, that markets have different characteristics for sure. So we definitely miss opportunities to specialize for a given market, right? So we are underfitting, as you would say. But I've in my career, I've never seen anyone go bankrupt because they underfit. But I've seen loads of people go bankrupt because they overfit. So, in terms of the risk reward, I'll bet on underfitting all day long and stay away from overfitting as much as possible.
Roger that. I think what you've just mentioned with that, up, down, up or zigzag type of move ties it to the fractals, which you were, or could possibly tie it to the fractal theory and the Mandelbrot theories that you were mentioning earlier, where you actually do not need a parameter such as a 100-day high that you need to observe, right? So that parameter just doesn't exist.
Exactly. Yeah, that's exactly right.
Great. So now let's maybe tie it or try to bring the conversation and combine it with your background in the energy space, because I think that's super interesting. And you have just mentioned, Bill, that the systems that you have implemented and decided to implement, they have a background and a history in some of the prop stuff that you've done on the desk, trading for Deutsche Bank or Trailstone. There's so much interesting stuff going on in these markets, like in coal and gas and dirty spark spreads and clean spark spreads and emissions. And, now LNG is becoming a bigger market. I mean, do these markets, do you still trade them? Did you take or did you bring what you've learned, your experiences from Trailstone and Deutsche over to 10 Dynamics so that you're now trading these spread and arbitrage trades still?
Yeah, and definitely my experience in energy has been hugely influential in the signals for sure, in how we use them, definitely. Also, just in the my history of being involved on the fundamental side for a long time, and then seeing how challenging that space has become and how the competition for fundamental information edge has gotten very, very intense. And I think it's much harder today than it was 15 years ago, because everyone's using the same models now, everyone gets the same data, so it's quite hard to have a new idea. Where when I look at the return on systematic strategies, they have good, this kind of clear cycle of outperformance and underperformance over time, over kind of multi-year timeframes. I think every sector has this natural sort of trendy environment that lasts for a few years and then not for a while. And I think the Sharpe ratio on systematic is the same today that it was in the 90s. And if I look at fundamental trading, I would say the Sharpe ratio around 2000 was much higher than it is today. So for sure that experience was very influential in my sort of belief that what we're doing is the right approach. And I used to think, as I was developing the signals, that I thought, well, there were times that I thought the signals, because we didn't have the full suite at the time or whatever, that there were times where as a human, I could do a better job than a fully automated system. But I don't believe that anymore. And I joke, I don't tie my shoes if the system doesn't say to do it. So I really think the system does as good a job as I could do, and estimating the probability for a given market move, right? So
there you go. How many? I forgot to ask. How many markets do you guys trade? Do you have a specific focus on the energies complex and power and gas and all that, or are you completely diverse? I mean, how large is the portfolio?
Well, ideally, we want it to be as large as possible, because again, the whole approach is to have something that's generic, and by taking the risk of, say, underfitting, we can make up for that through diversification. So if the model's successful in lots of different markets, then the more markets we add, the more our Sharpe ratio improves. What we're currently running on is our current managed accounts are trading in the energy space. That's where we started. Primarily, I think, because that's my background. So that's where it was the easiest place to get investors interested in what we were doing. But we've also recently added the Chinese futures markets to what we cover with the model. We have some interest there, which I think it's great. It's such a broad spectrum of markets you can trade there, and the liquidity is pretty good. Just difficult, as everybody knows, it's difficult to access, and that's the challenge. But yeah, we'd love to run it as broadly as we can. We do all the commodities markets. We do so the treasuries and European bond futures. We do stock indices with it. We do FX futures. So anywhere that we can find liquid futures, we tend to apply the model and continue to look for more markets. Unfortunately, on the futures side, we're a little bit limited. The China's kind of the last real liquid environment, I think, where we can extend things. But yeah, in general, we'd like to apply it to as many places as we can, and bet on the consistency, and that all markets should trend at some point, and the model should capture that when it happens.
You trade the internationalized Chinese futures markets, which are easier to get to because you can margin them in dollars, or are you trading the kind of like onshore Chinese markets, which are still kind of like blocked away from most offshore users?
Yeah, we're planning on using a WFI to access the domestic futures markets, which is, it has all of its own challenges and risks and stuff. And if somebody wanted to do the dollar-funded ones, we can certainly do it. There's just not as many of them. And the nice thing, I don't know if you how closely you've looked at the domestic ones, but I think there's 45 contracts that are liquid there, and they have a lot of contracts that we don't have. A lot of the chemicals contracts that you have available there are quite interesting, and it's a shame because it is a really nice broad portfolio. It would be amazing if it was a little bit easier for everybody to trade, but we're going to make an effort and see if we can access it.
Absolutely. What I also noticed, Bill, is that you included some single name large cap US equities and sector ETFs in your portfolio. And I just want to ask, is this in addition to the equity index futures, or is it a replacement for equity index future risk? Or maybe put differently, what interests you in these single name equities? What's special about them for you?
Well, this is another one of the things that we do that I guess, more of the traditional CTAs or systematics don't as much, but we can apply the model to single name equities and ETFs. And it works just as well in those markets as it does in the future space. And the reason to include them is and you know this if you ever done any portfolio construction, that equities tend to do very well in times when maybe the commodity markets aren't doing as well. And so there is a natural diversification. If you trade single name equities, the years that you do really well tend to be the years that the future side is not doing as well. I think there's real macro reasons for that. So I think that will continue to be the case. I think the best portfolio would be the combination of the two. And we trade large cap equities and the liquid ETFs that are out there for kind of sector ETFs, also the commodity ETFs, also the VIX related ETFs, because we trade VIX futures as well. The one thing that we do see, and I don't know if maybe other people will disagree with this, but for our model, we want things to behave quite normally, in the sense that things should trend and not be too jumpy. And so we don't apply, we do apply it to certain spreads in the commodity market. We don't apply it to spreads that tend to be stable and then have some sort of dislocating event that moves the spread, because I think that's not really what the model is designed to catch. So what's interesting in the equity space is the system works very well in really heavily traded, highly followed names where you get, good volatility and you've got liquidity and everything. But they tend not to be super gappy. Even on earnings announcements, they do a bit, but not so much. Where when you get down into the mid cap space, the mid cap and the small caps become really just beta plus earnings announcements plus noise kind of thing. So that's a tougher space, I think, for trend following. So we limit ourselves to basically the S&P 500, and even in there, we don't do all the industries. So we stay away from things like biotech and things that are, again, more jump related, news event related. But in general, it works great, and things like Nvidia and some of the big trending names we've talked about, and it is a really nice complement to the future side. And we asked about stock indices versus the single names. What we see is because we don't constrain the system on the equity side, we allow it to do whatever it wants to do, which means it does, you essentially get factor timing in there. So you trade 100 stocks are going up, you're going to be 80% long, 20% short in that environment. So you're going to have beta exposure. When stocks are going down, when you're in a bear market, you're going to have the opposite, right? So you're going to be 80% short, 20% long. So you've got time varying factor exposure. So you're definitely betting on the factors. And if you look at the return on the strategy, you make money betting on the factors, but you also make money on the individual stock selection. So it's a different approach. And it's not, as you know about the equity space, it tends to be like market neutral, and everybody has to be market neutral at the end of the day. And so it doesn't really fit that kind of strategy. So it's kind of I think it's a harder thing for most investors to get their head around what we're doing there. But, from my perspective, it's just a great fit with the future side that it, ideally we'll get to the point where that will be our flagship strategy will be something like 50% equities, 50% futures, and run it globally. That would be the dream when we get there.
Yes, good. Now, you just mentioned the VIX futures, and the question I always like to ask is, do you constrain the model on just trading them on the long side, or would you just as well be short VIX futures? How do you do that?
Yeah, we do constrain it. We don't go short the VIX futures, and in general, I have a very strong philosophy or I guess preference against negative convexity tail risk type strategies, which is why I don't like mean reversion in general, because that tends to be a negative convexity strategy. So if you look at our returns, we have positive skew in our return profile, which is great. I love that. That's where I want to be. And so for the VIX, we're able, on the VIX side, the system historically has performed on a net basis by buying VIX. So that's basically saying you're buying insurance and getting paid to do it. And that to me is like a great addition to the system, and it works as you would expect. When you don't have a big event, you tend to be sort of bleeding a little bit on the VIX, but hopefully it's a lot less than the time decay you would get by just being long VIX. That's the idea behind the strategy. And then of course, when it performs, you're picking up a lot of return there, and I think it's a great addition. I'm sure, it's hugely popular. There's a bunch of people doing it now, and I think for us, it makes a lot of sense. And I still want to be short VIX because we haven't really seen a complete out of the blue VIX spike. I mean, it moves fast when it moves, but it's never been completely like you wake up one day and the VIX is at 60, right? It goes from 15 to 60 over a few days or weeks at least. But I just don't want to be short that. You don't want to walk in and lose 20% of your portfolio on a day just because you're short VIX. So we happy to stay away from it. Even historically, it looks pretty good. Short VIX looks pretty good historically, but yeah, that's braver. It's for braver people than me.
Yeah, look, I mean, selling out of the money puts on the S&P 500 also looks good historically. The question is whether you can maintain the path. Like, you look at that ensemble, but maybe at some point the pain is too large. And if you're the one who kind of like has an uncle point in a drawdown, you're no longer part of that average, and your return profile and experience will look very different, and maybe you will never make your losses back. So it is a tough one. Now, I was just thinking, like with the way that you trade and the 30-minute resampling and the big machine that you have running, I was just thinking like and I'm sure there are several trend replicating ETFs that have come up in recent months, years. And first, what do you think of them? And then second, do you think 10 dynamics could ever be replicated, given the way that you trade?
Well, this comes a little bit down to what we were talking at the very beginning. Is it a factor? Like if it's a factor, can people figure out what the factor is and replicate it? Like we do with beta. So in theory, yes, I think that's possible. Although it seems to be a lot harder because the replicating guys, there's been some good strides lately to do that. But actually the premium, the returns the shelf ratio is relatively low. So we've been thinking about, because it's people are talking about, well, is trend a commodity, right? We thought, well, okay, well, if trend's a commodity, then we're going to create a market neutral systematic where we're long our strategy and we're short one of these replicators. And we've already looked at the return profiles, and it drops our Sharpe a bit, but it doesn't, certainly We still have completely uncorrelated Sharpe with the replicator. So to the extent that they have captured whatever the trend is, then that's fine. I don't think that's an unreasonable approach for systematic strategies. But the caveat to that is, if we've talked to a few allocators and stuff that see a lot of systematic strategies, and they said one of the characteristics of the systematic space is the huge dispersion in returns. So yes, there seems to be an average, call it trend, but there's a massive dispersion compared to, look at beta. Beta, there's no dispersion. There's a very little dispersion around the beta strategy, right? You kind of know what it is. So I don't know. Again, this is this. What are we actually doing with systematic? What are we capturing? And so any investor who says, "Oh, well, you're just commoditized trend," I'll say, "Well, then let's pick your favorite trend replicating strategy, and we'll go short that against us, and let's see how that looks." So that's one. I guess that would be our sort of way of dealing with that.
Yeah, maybe this is a great point to end the conversation. Is trend following a factor? Is it beta? Is it alpha? Can it easily be replicated? We've heard many times, or some people say that trend following is a commoditized beta return stream. I don't think it is true. That is my opinion, because we're long and short markets at different points in time. We go in and out. So we're kind of like actively decoupling from the beta return stream. And whatever it is that we're producing cannot just be beta, given the fact that we're trading on both sides at different points in time. But yeah, leave it there. Bill, it's been great chatting with you. Good trading conversation. And thank you for joining me today on the Open Interest series. And a quick note to our podcast listeners. As usual, I say this all the time. We'll include the most important points of today's discussion with Bill in our show notes. And please, if you have any questions, be that for Bill or I, just email us. You can reach us at info@toptradersunplugged.com, and we'll always pick it up and respond. Now, most importantly, in addition to thanking you for listening, have a Merry Christmas, because this is likely going to be the last episode of that year. Happy holidays, a prosperous new year, and we're all looking forward to being back with you in 2025.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.